Bitcoin has been growing in popularity very quickly around the world. First, we saw El Salvador adopt Bitcoin as its national currency. Then we saw the SEC accept the first Bitcoin ETF. And then we saw Bitcoin start to enter the credit card market because MasterCard said that they're going to start allowing Bitcoin rewards. And now we're going to start to see some even more changes in the Bitcoin market. So if you're interested in what's going on with cryptocurrency and Bitcoin, you want to make sure you watch this video till the end. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Cryptocurrency and Bitcoin is one of those things where either you hate it or you love it. There's no in between. Either people love Bitcoin and they want cryptocurrency and Bitcoin to be the future in everything that you do, or you absolutely hate cryptocurrency, you hate Bitcoin, you hate the idea of it. You have a very small middle ground, but what you're seeing happen is you're seeing more and more people jump from this I hate Bitcoin to I love Bitcoin. And then you have some people that openly talk about how they hate cryptocurrency, but then secretly invest in cryptocurrency. Back in 2017, Jamie Dimon, the CEO of JP Morgan Chase Bank, came out and said that you're stupid if you buy Bitcoin. And then more recently, towards the end of 2021, Jamie Dimon came back out again and said that Bitcoin is, quote, worthless, but you can buy it if you want. But this is where things get interesting, because Business Insider put out an article that is titled, "These 13 banks have invested the most in crypto and blockchain to date." And if you scroll down to number 7, what do you see? Oh, JP Morgan Chase Bank has invested more than $200 million into cryptocurrency and blockchain technologies. Now, it's safe to say that investing in cryptocurrency isn't always easy because you have a lot of volatility with cryptocurrency. That's the price that you pay for investing into this thing, which is supposed to be the future of money and kind of the future of the internet, because there's the whole blockchain, the whole technology behind cryptocurrency, which makes it more than just currency. I'll keep this as blunt as I can make it. There is a chance that we could see another 2001 style .com crash in the cryptocurrency market. But that doesn't mean the cryptocurrency will just fade away. I mean, after we saw the 2001 .com crash, we didn't see the internet go away. Yeah, some internet companies failed. Yeah, some internet companies lost a lot of market cap, and we saw a lot of downturn in the internet world. But the internet came roaring back, and look at where we are now with the internet. Cryptocurrency and the blockchain are changing the way not only how we transact money, but also how we use the internet. And now, as we're starting to go through the next phase of adoption of cryptocurrencies and Bitcoin, we're starting to see some more changes which could make Bitcoin go even more crazy than it is right now. And so I want to start by talking about the first major change that we have going on. But before I get into that, I need you to do me a quick favor and smash the thumbs up button below. Saw the first Bitcoin ETF hit the stock market, and this caused the Bitcoin price to boom. We saw Bitcoin hit a new record high at the time of right around $65,000 per coin. Right after the first Bitcoin ETF hit the market, we saw the second Bitcoin ETF hit the market the next week, and that helped continue this Bitcoin rally. You can see that there was a lot of excitement behind these Bitcoin future ETFs, because as soon as the first ETF hit the market, BITO, B-I-T-O, this was created by a company called ProShares. As soon as it hit the market, it hit $1 billion worth of assets under management, which means you saw $1 billion enter this ETF. That was the fastest ETF to hit $1 billion in assets under management in history. And that's exciting for a lot of cryptocurrency investors, because this was an ETF that was a derivative of Bitcoin, so cryptocurrency. To put it in perspective, the ETF that held that title before this Bitcoin ETF was the GLD Gold ETF, and this was set back in 2004 when it took 3 days for the Gold ETF to hit $1 billion in assets under management. Now, there's a couple things that are worth noting about these ETFs and what's going on around it, because a lot of cryptocurrency people and Bitcoin people are very excited about it, because it shows that, okay, the SEC approved this ETF, so we're starting to see more adoption of this Bitcoin or cryptocurrency world, which is great. And now you have people being able to invest into cryptocurrencies and Bitcoin through Wall Street, which means that you're going to see more buyers come into Bitcoin, you're going to see more buyers come into cryptocurrency, which is going to help cryptocurrency prices go to the moon. Yeah, well, it's true that these ETFs help drive more publicity and more validation towards Bitcoin and cryptocurrency, and now you have these big asset managers buying these Bitcoin ETFs. You have to understand that this is a derivative of Bitcoin. It's not actually Bitcoin. See, BITO is not an actual Bitcoin ETF, it's a Bitcoin futures ETF. When you go out and you invest in an ETF that gives you exposure to the S&P 500, now this ETF is actually owning shares of these companies in the S&P 500. So when you own an ETF, you're essentially owning shares of the companies indirectly because the ETF that you're investing in invests and owns those shares. This Bitcoin ETF does not own any Bitcoin. It is a Bitcoin futures ETF, meaning it is a derivative, kind of a derivative, because what it's doing is it's allowing you to invest and get exposure to Bitcoin by not actually owning any Bitcoin. Futures contracts are very popular in the commodities industry because it is a way for you to hedge your risk. So let's say that you need a whole bunch of gas to fill up your trucks or your planes or whatever it is. You need gas to do that, and you sell tickets for people to ride onto airplanes. Well, it can be risky to sell tickets for next month if you don't know what gas prices are going to be next month. So what you can do is you can buy a futures contract where you buy a predetermined amount of oil at a predetermined price. You're buying it at a future price because you don't know what the price of oil is going to be. With Bitcoin and this Bitcoin futures contract, you're not actually buying Bitcoin in the future, you're just investing in this ETF, which is giving you exposure to Bitcoin's price in the future, when you could actually just go and buy Bitcoin by using a cryptocurrency exchange. If this ETF actually owned Bitcoin, it would be a derivative of Bitcoin. But it doesn't. It invests in futures contracts, and you don't get any Bitcoin at the end of it. So you're not investing in a derivative of Bitcoin, you're investing in a derivative of Bitcoin. Now at this point you might be wondering, what the heck does all this mean, Jaspreet? All I know is that this ETF is bringing more publicity and more PR to Bitcoin and is legitimizing Bitcoin and cryptocurrency because now you have Wall Street pouring their money into assets that give exposure to Bitcoin. I like to look at history, and history doesn't repeat itself, but it does rhyme. And if you remember before the 2008 crash, what caused the 2008 real estate crash to be so much bigger than it could have been if it was just contained in the real estate market? It was because banks started creating derivatives and more derivatives and derivatives upon derivatives of this mortgage market. And then they started selling these investments and more money started going in. So now people were not betting on the actual housing market, they were betting on derivatives and derivatives of the housing market. And so this created a house of cards in the housing market. Now I get it, cryptocurrency and the housing market are two completely different things. I get it that this is not the exact same as that. But what I'm trying to say is anytime we start to see more and more derivatives created upon an asset where you can very easily go and buy the asset, because it's not that hard for somebody to go out and buy Bitcoin. Just go and open an account with BlockFi or Coinbase or Gemini. You can create an account, buy some Bitcoin. It only takes a few minutes. But the whole idea behind the ETF is it is supposed to give people access even easier to get exposure to Bitcoin. But they're not actually getting exposure to Bitcoin. You're getting a derivative of that, which makes it risky. Now, I know, I'm just a random guy on YouTube, which is why you need to make sure you do your own due diligence and never blindly listen to a random guy on YouTube, but I own actual Bitcoin. I don't own the ETF, but this is where you got to be a little bit cautious and be a little bit wary, because anytime you start to see all these derivatives of derivatives coming on, now you start to build a bigger house of cards because people don't just want to own the asset, they're just trying to get rich off of the asset without actually owning the asset. Look, now that we have the first Bitcoin ETF on the market, it has opened the floodgates for companies trying to capitalize on this by creating and opening more Bitcoin and cryptocurrency ETFs, and some of them are risky. The Wall Street Journal put out a piece titled, "The SEC will not approve leveraged Bitcoin funds yet." With the subtitle, "The regulator has signaled it will only allow unleveraged funds tied to the cryptocurrency, at least for now." As soon as you saw the first Bitcoin ETF hit the market, you saw companies going to the SEC saying, "Hey, let us create a Bitcoin ETF too, but we want to do something a little bit different. We want to do it with leverage. We want to allow people to double up their bets or triple over their bets by allowing us to invest in Bitcoin with a whole bunch of leverage. So if Bitcoin goes up, people will be able to make even more money, not just the 10% that they see it rise, but by 25% or 50%, because we want to use leverage to invest in these assets, and we will be able to make even more money for our investors." And the SEC said no. It says that Valkyrie Investments proposed to launch a new fund that sought to amplify the daily returns of a portfolio of Bitcoin derivatives, including futures contracts and options, by using 1.5 times leverage or borrowed money. And then that very same day, you had a different company go to the SEC and they said that they wanted to create an ETF that allows you, investors, to now bet against the Bitcoin futures contracts to use by ProShares, so the BITO ETF. So this is where things get a little bit tricky because, yeah, it's cool. You're starting to see these cryptocurrency ETFs hit the market, which start to give you a little bit of validation because it shows you that Wall Street wants to put their money into cryptocurrency. But what's interesting is they can actually use their money to buy the actual asset. They can use their money to buy Bitcoin or any other cryptocurrency just as easily as it would be for them to go out and buy the ETF. But the reason why these ETFs can be a little bit risky is because now they're derivatives. Not just direct derivatives, but derivatives upon derivatives. And now you have a whole share of companies that are trying to create these highly leveraged ETFs, which right now they're not allowed to. We don't know if that's going to stay that way or not, but they're trying to create these highly leveraged ETFs, which will allow you to not just invest your money in a derivative of a derivative, but now to up your bets by allowing these companies to use high amounts of debt. That way they can increase your profits if it makes money, which also means if it loses money, you lose even more money. And then you have companies like I just mentioned trying to create ETFs which let you bet against the whole thing. This is where I want you to be financially educated. That way you can proceed with caution and make sure you're investing in the right things. Know what you're investing in. If you're investing in these ETFs, know what you're actually getting and understand that, hey, we are having volatility and hey, there are more risks coming anytime you see more derivatives upon derivatives, because now you have a whole bunch of money flowing into building this house of cards that is reliant on this one asset class, which can make things a little bit scarier. So you just want to be smart and understand what it is that you want to invest in, and you want to understand that, hey, if you're investing for the long term, you want to be a long-term investor, and that doesn't mean that you're going to see things go straight up like this. You can see things go down like this, back up like this, so you just got to be a little bit smart. The second thing that you want to pay attention to has to do with MasterCard, the credit card company who says that now they want to start incorporating cryptocurrency. CNBC explains it very well because MasterCard said that they want any bank or any merchant on their network to offer cryptocurrency services, and that means that you can have thousands of banks and millions of merchants on their payment networks to now integrate cryptocurrency into their products. That means you could potentially pay for things with your Bitcoin wallet if you can sync it with MasterCard. That also means that you could potentially get paid with cash back, not in cash, but now Bitcoin. This is what a lot of people have been waiting for, the adoption effect of cryptocurrency, which would allow people to actually make transactions with cryptocurrency like Bitcoin. Like Bitcoin is supposed to be used as a currency, which means you're supposed to be able to use it to buy and sell things, but it's hard when the person you're trying to buy something from doesn't allow you to pay for it with cryptocurrency. If you go to Walmart today and you try to check out, they're going to require you to pay with cash or your credit card, and right now your credit card probably doesn't sync with Bitcoin. But now if this changes, that means now not only can you pay with cash or your credit card, you might be able to pay with Bitcoin through one of your credit cards. Or maybe in the not so distant future, you'll be able to pay with Bitcoin without using a credit card. This would ultimately change the game for cryptocurrency, because if we start to see companies and payment merchants start to adopt cryptocurrency, that means you could go to a company who doesn't mind accepting cryptocurrency and who has a merchant, a payment merchant, which allows you to pay with cryptocurrency. That means you can go to this company, buy their products, and then pay them with cryptocurrency like Bitcoin. Now this is hard because sometimes it's not that easy to do. You'd have to get their wallet address and then go to your phone and enter their wallet address. It's not very streamlined. But if the payment merchant allows you to now pay with Bitcoin or any other cryptocurrency, that means you could just tap your phone or use a credit card, whatever it might be, to now pay with your Bitcoin or other cryptocurrency. Now, obviously, this isn't going to be very easy because you're going to see the government come in and they're going to want to probably try to regulate it. I mean, you're already seeing the Biden administration say that they want to monitor all purchases, every transaction over $10,000. If you make a transaction over $10,000, they want your bank or your financial institution to report it to the government and the IRS. And so you have to imagine that if people are buying things not through their bank anymore, but through their Bitcoin or cryptocurrency, that they're not going to be very happy with it and they're going to try to regulate that. So you have to imagine that that is going to be a hurdle that any company and merchant is going to have to go through. And then you're going to also have the hurdle of people actually willing to give away their cryptocurrency, because a lot of people are holding on to cryptocurrencies like Bitcoin, hoping that it's going to go a whole lot higher. So people don't want to actually pay with Bitcoin. they're actually just paying with dollars and they're holding on to their Bitcoin and cryptocurrencies. So that's going to be one of the tougher things to make people actually want to adopt it as a currency, because if you think that Bitcoin is going to be worth twice as much in the future, why would you want to spend it today to buy some candy or some extra guac? But these hurdles aren't anything that are unexpected. It's a part of the process, and if people start to use Bitcoin or cryptocurrency as an actual means of exchange, well, then that could change the game, and that can make a whole lot more people interested in actually owning cryptocurrency. And the third thing that you want to pay attention to with cryptocurrency like Bitcoin is inflation, because a lot of people are starting to realize that these inflation numbers that we're getting from the Federal Reserve Bank and the government, while they keep saying it's transitory, they keep extending how long this transitory is. Because originally the Federal Reserve Bank and the government came out and said that this inflation is very transitory, and by mid-2021, all this inflation will go away. And then that didn't happen. And then they said you can expect inflation to really cool down by the end of 2021. That didn't happen. Actually, inflation ramped up. And now they're saying that you're going to see inflation into at least mid-2022 or late 2022. Now, I'm not going to do a deep dive into inflation in this video. I've already made a ton of videos talking about that, so you can check those out if you want to know more about what's going on. But the real issue here is, yes, there are two factors to inflation. You have the money printing, which has diluted the value of our dollar, and then you have all the supply chain issues. You have both of them going together. As the supply chain issues start to fix, then you will start to see the price of some things go down, but then you're also going to see the real cost of all the money printing that happened, because there's a cost to printing all this money. When the government spent trillions of dollars that it didn't have and that they don't have through taxes, somebody has to pay the price. And the person who pays that price is the person who doesn't understand that they're going to have to pay the price. It's the average person, because now the value of a dollar goes down, which makes the price of things go up. And this is where people have been really starting to move towards things like cryptocurrency and even things like gold, because they understand that, okay, if the dollar can be devalued because it is an inflationary currency, because you can just print as much money as you want, you can print as much dollars as you want, people want to own something that has a limited supply. Something like gold or something like Bitcoin, because Bitcoin has a limited supply. You can only mine 21 million Bitcoins, which means Bitcoin is actually a deflationary asset. There's no more Bitcoin that you can create, which means if you own some Bitcoin and more people start to buy Bitcoin, well, then that will create more scarcity in Bitcoin, which will create more value behind Bitcoin, assuming that it can actually be used. As unfortunate as all this inflation is, the reality is this inflation that we're seeing going on is a big driving factor for people moving their money to Bitcoin, because they want to be able to preserve their wealth. They want to be able to preserve their dollars. They can save $10,000 in the bank and they see the price of everything around them, their rent, their groceries just skyrocket, which is not good if you're trying to actually maintain and grow your wealth, which is one of the reasons why people have been moving their money to cryptocurrency, although it's hard because now it's still very volatile. You see big rises and then you see big crashes, but people are starting to really lose faith in the Federal Reserve Bank, which is why they're willing to take that risk and they're willing to accept this volatility kind of as the consequence of trying to preserve your wealth. And kind of a derivative on the whole inflation side of things, you're also seeing the Biden administration saying that they want to monitor all transactions over $10,000. Now, whether or not you believe this is good or bad, the reality of what's going on with that is people are saying, hey, that's an invasion of my privacy, or hey, I don't want you to do that. And so people have been moving their money because of that to things like cryptocurrency, because the whole idea of cryptocurrency is it's supposed to be decentralized, meaning it's not controlled by one central entity, so now it's not controlled by the Federal Reserve Bank or the government, and it's not intended to be regulated and monitored the same way that our dollars can be by the government. Back in the day, if people wanted to be able to preserve their wealth outside of the bank, they did not want to keep the money in the bank, they didn't want to put it in the market because they don't know what's going on in the market, the thing that they would do is they would buy land or they would buy gold. The tough thing about land and gold is, yes, gold you can transport from America to India to China, anywhere you want, but it's not easy. It's very heavy. You cannot transport your land like that. If you want to transport your land, you're going to have to sell your land, take the cash, and then move the cash somewhere else. With gold, you can move it, but it's not very practical. Cryptocurrency is aiming to change that, where now you get that store of wealth because you have a limited supply of things like Bitcoin, and then you can also move Bitcoin very easily. It's not like gold where you have to take a whole suitcase full of gold, and then if you try to take your suitcase full of gold through the TSA, they're probably going to inspect you or do something with it. I don't know what they would do, but they would do something. But with Bitcoin, it's very easy for you to transfer Bitcoin or cryptocurrency from one place in the world to the other. I mean, it just takes seconds. Or if you just needed to use your Bitcoin yourself, well, then you can just access it off of your phone. So now the question is, what does all this mean? Yeah, we're starting to see these ETFs creating derivatives of Bitcoin, which is allowing for more people to adopt Bitcoin. And then we're starting to see the actual use of Bitcoin through things like MasterCard talking about how they're trying to incorporate Bitcoin. And now we're seeing people wanting to move their money to things like Bitcoin because they're worried about inflation. So what does all this mean? Well, what this means is people are starting to adopt and believe in Bitcoin more and more. But that doesn't mean that it's going to be straight up, because we're going to see more volatility, especially now that we're seeing derivatives upon derivatives of Bitcoin. And it doesn't look like these derivatives are going to go away. So at the foundation, you have this asset, Bitcoin and cryptocurrency. And more people are starting to move their money towards this Bitcoin because they believe this thing has value. But for it to actually have value, it must be actually used. And it looks like it's starting to move in that direction, which is good. But at the same time, you have other companies that are trying to capitalize on this potential value. I don't know if they believe it has value or not, but they're trying to capitalize on this movement of money towards cryptocurrency by building derivatives on this asset. Now, anytime you build derivatives, you start to build a house of cards. Now, a house of cards can stand up by itself for pretty long. I mean, if there's no air, if there's no wind blowing, it can stand up forever. But if that gust of wind comes in and it knocks the house of cards down, that can make the whole thing go down. That means before you go and spend any money, you need to know exactly what you're buying and why you're buying it. Do you want to buy the actual asset, or do you want to buy a derivative of the asset? Sure, you can make money off of derivatives. You saw a lot of people make money on derivatives before the 2008 crash. But when the crash happened, those derivatives became worthless, even though the asset, real estate, still has value today. And so you got to understand what it is that you're buying and why you're buying it. Why do you want to buy it? Do you believe in the future value of it, or do you just want to try to see if you can trade it and make some money? I'm not a trader. I don't like the idea of trading. It's gambling to me, but you have to understand what it is that you're doing. That way you can make financially smart decisions with your money and understand what it is that you're actually buying. If you like what you saw so far, then you're gonna love this. The 5 areas that have been seeing some of the highest inflation are cars, especially when we're talking about used cars, gasoline, meat, car rentals, and airlines if you want to go and travel somewhere. Let's start with cars. Companies are not able to produce cars anymore, new cars, because there's a chip shortage. When the pandemic first hit, manufacturers around the world shut down, and these manufacturers stopped producing chips, these computer chips. Well, car companies can't get a hold of these computer chips right now because all the computer chips that were out there were used to produce new video games, new PS4s, new Xboxes, and so now car companies are struggling to find new chips. And so because of that, it's harder for car companies to produce new cars, which is making it harder for people to find new cars available for sale. And so because people can't find new cars, they've been turning to used cars. And so before, back in 2020, when there was a whole bunch of uncertainty going on, we had a huge amount of used cars available for sale. And now in 2021, in the later part of 2021, it's the opposite. We have a lot of people that are trying to buy used cars because there aren't enough new cars out there, and this has pushed the price of new cars way up. Same with gas. When the 2020 pandemic hit, the whole world shut down, so the whole world stopped using gas because people weren't driving and plants were not running, so the need for gas went way down, and so we saw the production of oil also go way down. Well, the production of oil hasn't really picked back up yet, and a lot of these oil companies haven't really come to an agreement on how much oil they should be producing. And so because we have less oil being produced right now, the price of gas is way up here. I was actually driving around the outskirts of Chicago the other day, and I'm not talking about downtown, I'm talking about the outskirts. And regular gas was $4.09 a gallon, and if you wanted premium gas, it was $5.09 a gallon. We're seeing the same issues with meat, and with car rentals a little bit interesting, because what car rental companies were doing was, back when the 2020 pandemic hit, many of these car rental companies ran into a lot of financial problems, so they started liquidating their inventory, meaning they started selling off the cars in their lot because nobody was traveling in 2020. Well, now in 2021, where you have a lot of people trying to go back to real life, trying to travel again, and you have these car companies, these car rental companies that don't have as many cars on their lots because they sold off so many, and so now you have way less car rentals out there, and a lot of people that want to rent the limited supply of rental cars there are, which is again pushing the price of rental cars up. And then we have airlines also running into similar issues, where one, airlines are having to pay higher prices for gas, and second, a lot of airlines are not running at 100% capacity, which means you have less flights going from one place to another. So if you have half the flights going from New York to California and the same amount of people want to go from New York to California, well, this is what's pushing the price of flights up, because there aren't as many seats going from one place to the other. And I haven't even touched the housing market because we have other videos where I talk about that, but as you all know, we're also seeing a huge increase in housing costs, and I don't care if we're talking about rentals or owning a home, the price of housing across the board has been skyrocketing because of all the other issues that I talked about. You have a lot of people that want to go out and buy a home or rent a home, and not that much inventory available for sale. This is why it's no surprise that the new July inflation report that just came out said that we broke another 12-year record with inflation. So the Wall Street Journal did a very interesting write-up on the current state of our inflation that we're seeing right now. And what they said is that yes, the inflation that we saw between July of 2020 and July of 2021 is record-breaking. The good news is the amount of inflation that we're seeing month over month, so between June to July, has decreased. So what we saw between May to June was very high, and what we're seeing from June to July is high, but it's not as high as it was. That might be a little confusing to understand, but the article had a really good analogy that I think you'll appreciate. So what it says is that between May to June, our economy had 104 fever. Now between June to July, we saw the economy go down to 101 fever. It's still a fever, but it's not as bad as it was. What that means is we're still seeing the price of things around us grow very quickly. It's just not growing as fast as it was a little while ago. But one of the reasons that we see the inflation that we have right now is because the value of our dollars are being diluted. This is what inflation is. Inflation is when the value of your currency drops, which causes the price of things around you to go up. And one of the things that causes this type of inflation is when you have more dollars out in circulation, because when there's a lot more dollars out there, the value of each dollar that you have goes down. The Federal Reserve Bank is the central banking system in the United States, and they are the entity that controls our monetary supply. Now, the interesting thing about the Federal Reserve Bank is that although it's called the Federal Reserve Bank, it's really not a bank because you and I can't go there to deposit money. It's not a reserve because they don't keep cash reserves anywhere, and it's not federal. They even say so on their website. They are a private entity. But the Federal Reserve Bank has the ability to control our monetary supply because they can work with the Treasury Department to print money, and they can also control interest rates, and both of these things have a big impact on the inflation that we see. When you print more money and you inject this money into our economy, this creates more inflation because now you have more dollars floating around, and when you have lower interest rates, this also creates more inflation because now people are more likely to go to the bank and borrow money, which adds more dollars into our economic system. So when you have more dollars in the economic system, the value of each dollar that you and I have goes down, which in turn causes the price of things around us to go up. So the Federal Reserve Bank has been working with the government to increase inflation because that will allow the economy to grow, because they want to get more money, more dollars into the hands of people and businesses, that where businesses can go out and hire more people and create more jobs. That way the economy can grow, and that will get the economy and the system running again. Now this is kind of like a tug of war, because on one hand you have a healthy amount of inflation where yeah, you're adding more dollars into the system, people are making more money, the economy is growing, which is good. But on the backside and the risk is too much inflation, because at the same time while you're doing that, the value of our dollars keep losing value. And so if you do too much inflation, well, now the dollars that you have are worthless, or they're not worth as much as you'd hope. And now the people that have been saving money and working hard to earn money are not able to afford their regular life because the price of things are so much and people aren't making enough money to afford the cost of living. So this is the tug of war that the Federal Reserve Bank has been dealing with. And what they say is that before they start to slow down inflation, they want to see two things happen. They want to see inflation hover at around 2% a year consistently, and they want to see the job market come back. Now, for regular people who have regular costs, we've been seeing this 2% inflation. But the Federal Reserve Bank has their own indicator of what they believe is 2% inflation. And just recently, after the most recent inflation report, the Federal Reserve Bank says that they think that we're hitting around this 2% inflation figure. Let me read you a quote from a Yahoo Finance article so you know what I mean. Under the Fed's current policy guidance, rates will rise, quote, when inflation hits 2%, which I think that you can argue it already has. And it looks like it is going to sustain there. That quote is from a speech given by a president of the Federal Reserve Bank, so it sounds like the Federal Reserve Bank is finally starting to think that we're hitting around 2% inflation. Well, back in 2020, the Federal Reserve Bank created this rule where they said that they were not going to stop the money printing, and they were not going to raise interest rates until we saw inflation hit at least 2% and even exceeds 2% a little bit a year. And they also want to see employment hit the maximum amount possible. But according to what the Federal Reserve Bank says, the thing that's holding them back from making more drastic action is they're still worried about the employment market. They're not seeing enough people go back to work, and because of that, they're still scared to raise interest rates, and they're still scared to slow down their money printing. However, there are some new developments on that money printing side. The Federal Reserve Bank, at the time we're recording this video, is printing right around $120 billion every single month, and they're using this money to buy up bonds and other things to keep our markets afloat. So essentially, this is a $120 billion monthly bailout going into our markets so investors feel more comfortable investing their money into things like bonds and stocks. Originally, the Federal Reserve Bank kept saying that they're not going to raise interest rates until at least 2023, and they don't plan on stopping this money printing until something around then, or at least much later, until the economy has fully stabilized. But now you're starting to hear something different. You're hearing that depending on what happens in August and September, we could start seeing this money printing start to taper away. The reason why the Federal Reserve Bank doesn't just want to stop these asset buybacks right now is because that's what they did after the 2008 crash. After the 2008 crash, the Federal Reserve Bank was also printing money every single month to buy back assets, to keep investors confident, to invest their money back in the market. And then when they suddenly stopped that, it created a small stock market crash, and they labeled that the taper tantrum. And so the Federal Reserve Bank says that they're worried about causing another taper tantrum crash. And so to prevent this crash, what they're saying is they want to be more cautious, and they want to slowly wean their money away from the market. That way investors don't see another crash. Now, if we put everything that's going on in the economy aside for a second and just take a look at this, this is why financial education is so important, because you have the Federal Reserve Bank and the government working to make sure that investors are not scared to invest their money. What does that mean? So if you are financially educated, you have the government and the Federal Reserve Bank on your side working to bail you out, to make sure that you're okay. This is why financial education is so important, because you don't want to be one of the people that is paying the cost for this. You want to understand the system, and you want to understand the game. That way you can win in the game, because so many people are not financially educated and they're playing in a game where they don't even understand the rules. This is why you want to be financially educated. That way you can make smart decisions with your money, and that way you can be the person that's getting taken care of instead of being the person that's just paying the price. This is what financial education is all about. And if you want to learn more about this kind of financial education and how to manage your money and invest your money the right way, that way you can build your wealth, we have a free guide on money management and investing that you can read for free when you sign up for our daily newsletter. So if you want to read our free guide and build that financial education, I'll put the link to how you can download this free guide in the description below. Now, the Federal Reserve Bank and the government have been worried about the inflation that we're seeing, because time and time again you hear all the officials saying that the inflation that we're seeing is transitory, but at the same time they always kind of couple that with the fact that they say that inflation is a lot worse than what we expected and it could last longer than what we expected. So the Federal Reserve Bank has been worried about the inflation that they're seeing, which is why it's interesting to see that they're now finally talking about doing something about at least the money printing, and now they're saying that there's a chance that they could start raising interest rates a little bit sooner. They still say that it's not going to happen in 2021, but now you're starting to hear talks of potential rate hikes on interest rates in 2022. Again, the Fed keeps saying that the reason why they're not willing to take more action to help slow down inflation right now is because of the labor market. They said that finally we're starting to see some inflation, even though it looks like everybody else has been seeing this inflation for a long time. But the Federal Reserve Bank says they're finally starting to see the target inflation that they've been hoping for. But the issue is that they're not seeing the employment market go to where they want it to be. Every single industry right now is struggling to find employees, while at the same time, we still have millions of Americans that are out of a job. So it's kind of a weird dilemma. Yahoo Finance interviewed the CEO of a trucking company, and what he said is that this is the worst trucking shortage that he has ever seen. The CEO then went on to say that they may need to increase wages by 20 to 30% if they want to keep prospective drivers, but the issue is that the company can't afford to pay that much more money right now. This is a dilemma that you're seeing not just in the trucking industry, but every single industry where companies are looking to find work. And a lot of companies have raised how much money they're paying for their new employees, but the problem is sometimes this pay increase is still not enough to attract more employees. And so companies are having to decide, okay, do we pay even more money even if we can't afford to pay this money, or do we just not have an employee? So this is creating like a whole cyclical inflation. So you have the price of things going up, and when the price of things go up, people need to make more money in order to survive. If people want to make more money, companies have to pay you more money. For companies to be able to afford to pay you more money, they're going to have to earn more money. For companies to earn more money, they're going to have to raise their prices. If companies have to raise their prices to get their products, that means they're going to have to charge you more money. If you have to pay more money, that means companies have to pay more money, and on and on and on and on and on. So it starts to create this real inflationary spiral until something happens to slow it down or to break it. The worry is that up until now, people have been able to afford the higher prices of things because over the last 18 months, people haven't been spending all of the money, although recently people have started to go out and spend, but people still have some saved up cash because they weren't paying their mortgages and they weren't paying their student loans thanks to the forbearance program. So people had some extra cash, and maybe they got some extra cash from the government, and so people had some extra cash in their bank account which they wanted to spend. And now you go out and you go shopping and you see the prices of things are more expensive, but it's okay because you got some extra cash. And then you start to see a little bit of wage increases, which is good, which helps you support these higher prices, but then the price of things keep going up higher. But now, as this free money starts to go away, especially with the unemployment benefits now starting to go away, well, now you have the prices of things way up here, and if people's wages are not able to support that, then people are not going to be able to keep buying things. And at this point, companies are going to have to make a decision. What do? Do you accept the lower revenue, or are you going to try to cut costs to keep customers? This is what a lot of money nerds are sitting on the edge of their seats for, because they're trying to see what's going to happen next. Are we going to see a lot of inflation, or are we going to see deflation happen? Because it can go one of two ways. We could see a lot of inflation if the value of our dollar really drops, causing the price of things to go up, or we could also start seeing deflation where now people cannot afford the cost of living and all the extra dollars that have been printed were absorbed into the economy somewhere. And now people can't afford things, which is going to force the price of things to go down. And now companies are going to have to lower their profits. And now companies are going to have to start downsizing. And now you can see a real shift in the way that our economy functions. That's why it pays to pay attention. And we'll be keeping you posted on our YouTube channel, which is why if you haven't subscribed yet, make sure you do that. Thank you for watching. If you enjoyed this video, here's an interview that I did with Raul Paul on cryptocurrency that I think you'll love. And while you're at it, download our free guide on how to start generating passive income. And as always, keep hustling.
If you make something overly abundant, it becomes worthless. Now, it's not saying fiat currency is worthless yet, but basically the central banks are increasing their balance sheet by about 13% a year since 2008.